Welcome to JS Online Tuitions. Today in accounts we'll be looking at the sales daybook, the purchases daybook, the returns inwards daybook, the returns outwards daybook, and the general channel. So before we look at these daybooks, I just want to let you know that our online tuitions are up and running. We provide the following subjects: mathematics, science, biology, and accounts. The tuitions, they go at 100 kwacha per subject, and that's per month. For further information, you can text me on WhatsApp on 0973023620. So we are going to start with the sales daybook and the sales ledger. So the sales daybook is a book of original entry where credit transactions are recorded from copies of invoices issued to debtors before posting to the ledger in order of dates. When the goods have been sold on credit to the buyer by the seller will send the buyer a document showing full details of the goods sold and the prices of the goods. This document is called an invoice. It is known to the buyer as the purchaser's invoice and to the seller as the sales invoice. When the seller sells goods on credit to the buyer is given the original invoice and the seller remains with the carbon copy. The information that is recorded in the sales daybook is obtained from carbon copies of the sales invoice. So the diagram below shows an example of an invoice. In this example of an invoice, we have your purchase order, and the purchase order is 10/A/980. Then we have the invoice number. The invoice number is 16,554. Then we have the seller there on the top right, and the seller is J Siwale. Then the location of J Siwale is 7 over warehouse, Chipata LE12AP. Then the date that it was issued is 11th of April 2018. Then it was going to the buyer. The buyer there we have Hamlet, and his address is 45 Charles Street, Mandevo. Then we have the unit there. Then we have total. So looking at the details, we have 5 cases of candle. So per unit it's 5 kwacha. That means that to find the total there, we're going to say 5 cases of candle multiplied by 1 unit, which is 5 kwacha. So we say 5 multiplied by 5, the total we're going to have 25. Then we have 8 sheets from rubber, so we'll say 8 multiplied by 10 there, and we have our total as 80. Then we have 10 sheets blue cotton going at 20 kwacha per unit. To find the total, we're going to say 10 multiplied by 20, we're going to have 200. So there we can find the totals of the amount. So we have 25 plus 80 plus 200. The answer is 305. Then the terms there, we have 20% cash discount if paid within 1 month. Then let us look at making entries in the sales daybook and the sales ledger. All credit sales are recorded in the sales daybook in order of dates. After all the credit sales have been recorded, the amounts are totaled, and this shows the total credit sales for the period. The personal accounts of the customers in the sales ledger are debited with the amount of sales. The total credit sales is credited to the sales account in the general ledger, thus completing the double entry. If posting is done accurately, the sum of the individual amounts to the individual customers' amounts in the ledger should agree with the amount of credit sales in the sales ledger. Let us now look at the format of the sales daybook. So the format of the sales daybook can be given in 2 ways. The 2 formats include the first table not having the amount column and the second table having the amount column. The table having the amount column is used when the buyer is given the trade discount. So we have that first format, and for the first format we have title of the sales daybook, and in the first column we have date, in the second column we have details, in the third column we have invoice number, in the fourth column we have folio, and in the last column we have the invoice total. So the date just shows when the transaction took place. Then for the details there, we are going to put the name of the debtor or the name of the customer. Then the invoice number there, we can get it from the question. Then the folio there shows where that type of transaction has to be recorded in the ledger. So in this case, we are looking at the sales yearbook. That means that we're supposed to put the sales ledger, and the invoice total there is just the total amount. Let us look at the second formatty, and for the second formatty, the first thing that we have is title of the sales yearbook. Then we have date, details, invoice number, folio, amount, and invoice total. So there, the only difference is that in the first format we did not have the amount column, but in our second format we have the amount column. So what do we record in the amount column? So the transactions that are recorded in the amount column is cases whereby there was a discount or some amount was paid by cash. So which means some deductions have to be made before putting that amount in the invoice total. Let us now look at the purchases yearbook and the purchases ledger. The purchases yearbook is a book of original entry used for recording credit purchases. It is a book where we record goods bought by the business from its suppliers on credit. Whenever the business purchases the goods on credit, it is not given a receipt since it does not give in immediately cash but promises to pay later. Instead, it is given a purchases invoice by the supplier of the goods. The information recorded in the purchases journal is therefore obtained from the purchases invoice. In the purchases journal, names of creditors or suppliers and the money value of the credit supplier or goods supplied to the business on credit are recorded in order of dates when they were purchased. Let us now look at making entries in the purchases yearbook and in the purchases ledger. All credit purchases are recorded in order of dates in the purchases yearbook. After all the credit purchases have been recorded, the amounts are totaled, and this shows the total credit purchases for the period. The personal accounts of suppliers in the purchases ledger are credited with the amounts of purchases. The total credit purchases is debited to the purchases account in the general ledger, thus completing the double entry. If posting is done accurately, the sum of the individual amounts to the individual suppliers account in the ledger should agree with the amount of credit purchases in the purchases ledger. Let us now look at the formatting of the purchases yearbook. So the formatting of the purchases yearbook can be written in two ways. In one way, the formatting of the purchases yearbook can only have the total invoice, and in the other formatting can include both the amount column and the total invoice. The formatting that has only the total invoice is written when the business did not receive trade discount for that trading period. The formatting that has both the total invoice and the amount column is used when the business had received trade discount during that trading period. So we have that formatting. So the first formatting, we have title of the purchases yearbook, then we have date, details, invoice number, folio, and invoice total. So I already explained what this information means. The only difference there in the folio column there, that means that we need to include the purchases ledger. So we're going to have our PL. Then for the second formatting, we have title of the purchases yearbook, then we have date, details, invoice number, folio, amount, and invoice total. So returns inwards yearbook or sales returns yearbook. The returns inwards yearbook is a book of original entry in which the value of goods returned to the business by customers are recorded in order of dates. In this book, the name of each debtor who returned goods is recorded, and the value of goods returns in order of date when the goods were returned. The goods can be returned by the customer to the seller if the goods that were bought were damaged, if the goods that were sent to the customer were not matching to his or her expectations, goods delivered in excess of what the customer ordered for, or goods being different from what the customer ordered, among other reasons. If the customer returns goods that were previously sold to him or her to the seller gives the customer the document called the credit note that reduces the amount of money he or she is supposed to pay the seller. The customer is given the original credit note, and the carbon copies or duplicate remains with the seller's business box. It is these carbon copies of the credit note where the seller obtains information that is recorded in the sales returns book. So as you can see from the diagram there, it's an example of the credit note. Let us now look at making entries in the retains inwards daybook and the sales ledger. All sales retains or returns inwards are recorded in the retains inwards daybook in order of dates. After all the sales retains have been recorded, the amounts are totaled, and this shows the total credit retains for the period. The personal accounts of the customers in the sales ledger are credited with the amount of retains inwards. The total credit retains is debited to the retains inwards account in the general ledger, thus completing the double entry. If the posting is done accurately, the sum of individuals' amounts in the ledger should agree with the amount of credit returns inwards in the retains inwards account. Let us now look at the retains outwards daybook or the purchases retains daybook. The retains outwards daybook is a book of original entry in which the values of goods retained or taken back by the business to the suppliers are recorded in order of dates. In this book, the name of each creditor or seller to whom goods have been retained is recorded, and the value of goods retained in order of dates when retains have been made. The businessman or woman may sometimes retain goods that they had already bought to the supplier for the same reasons already identified under the retains inwards daybook. When the businessman or woman takes back goods to his or her supplier, the amount of money he or she was to pay is reduced by removing the value of goods retained. A document called a credit note is given to the businessman or woman by the supplier for this purpose. The information recorded in the retains outwards daybook is taken from the original credit note that is received from the suppliers to whom goods have been retained. Let us now look at making entries in the retains outwards daybook and the purchases ledger. All retains outwards are recorded in the retains outwards daybook in order of dates. After all the retains outwards have been recorded, the amounts are totaled, and this shows the total credit retains outwards for the period. The personal accounts of the suppliers in the purchases ledger are debited with the amount of retains outwards. The total credit retains outwards is credited to the retains outwards account in the general ledger, thus completing the double entry. If posting is done accurately, the sum of the individual amounts to the individual suppliers account in the ledger should agree with the amount of credit retains outwards in the retains outwards accounts. So let us now look at the general journal. The general journal is a book of original entry in which transactions that cannot be recorded in other prime entry books are recorded in order of dates when they occurred. In the general journal, the date of the transaction, name of the account to be debited, and name of account to be credited, and the amount of money or money value of the transactions are recorded. The general journal is also called the general proper or principal journal. Types of transactions recorded in the general journal. So we're going to start by looking at opening entries or balances. Balances brought forward from the previous period to open a new set of books are first recorded in the general journal before being transferred to the relevant ledger accounts. Such opening balances include balances of assets, liabilities, and capital. Then we have closing entries. A closing entry is a journal entry made at the end of the accounting period. The closing entry is used to transfer information from the temporary accounts to the permanent balance sheet or income statement accounts. The purpose of the closing entry is to bring the temporary journal account balances to zero for the next accounting period. At the end of the year, all revenue and expenses accounts are closed. Their balances are transferred to the trading account to be used in calculating the gross profit, and to the profit and loss account to be used in calculating net profit. The transfer of these closing records of accounts is recorded in the general journal. Then let us look at purchasing of fixed assets on credit. Fixed assets like land, furniture, and machinery bought by the business on credit are not recorded in the cash book since there is no immediate transfer of cash involved. They are not recorded in the purchases journal since they are not bought for resale but for use. The term purchases in accounting is strictly used to mean value of goods bought for resale. So they are first recorded in the general journal before being posted in their respective ledger accounts. Then we have sales of fixed assets on credit. When fixed assets like land, furniture and machinery are sold on credit, they are not recorded in the cash book. Since there is no immediate cash transfer involved, they are not even recorded in the sales journal since they are not bought for resale. The term sales in accounting is strictly used to mean goods sold by the business but must have been bought for resale. So they are recorded in the general journal before being posted in their respective ledger accounts. Then we have collection of double errors detected in double entry in recording of transactions. Collection of errors discovered by the trial balance or using any other method are recorded using double entry in the general journal. Then end of year adjustments. These are changes made in the values of assets, liabilities, expenses and revenues to get the actual value of such amounts when preparing financial statements. Such adjustments include depreciation, accrued or outstanding expenses, accrued or outstanding incomes, prepaid incomes or income received by the business in advance and prepaid expenses made by the business in advance, and provision for bad and doubtful debts, among others. These adjustments are first recorded in the general journal. Then we have issue of shares. When shares are issued by the company, they are first recorded in the general journal. Let us now look at the ledger. When a transaction takes place, the evidence of the transaction is prepared, which are referred to as the source documents. The information in the source document is first recorded in the books of original entry or journal before the transactions are recorded in the ledger book. A ledger book is an accounting book of final entry where transactions of similar nature are summarized in separate accounts in order of dates after being recorded in books of original entry. The ledger is also referred to as the main book of accounts because it is a book where accounts are kept. In the ledger, each account is placed on a separate page. Let us now look at the formatting of the ledger. So we have name of account, then in the first column we have date, in the second column we have details, in the third column we have folio, then we have the debit and the credit. Let us now look at the difference between the ledger and the journal. So the first difference, we have the process of recording transaction in the journal is referred to as journalizing, while recording transaction in the ledger is called posting. Since transactions are just transferred from the journal to the ledger account. Then the second difference there, we have after making entries in the journal, they are transferred to the ledger, but entries in the ledger do not go back to the journal, but they go to the trial balance according to the accounting period. Then our third difference, we have the journal is a book of original entry while the ledger is the main book of accounts. Then the fourth difference, we have the ledger is the main book of accounts which doesn't appear in the journal. Then the last difference there, we have the information in the journal is obtained from the source documents while the information in the ledger is obtained from the journal and other sources. Let us now look at the types of accounts kept in the ledger. There are two types of accounts, namely personal accounts and impersonal accounts. Impersonal accounts can further be divided into real accounts and nominal accounts. So these accounts are described as follows. So we have the personal accounts. So what are personal accounts? These are accounts which deals with business transactions carried out with person, firms and the business. These types of accounts exist in the names of the person and firms. They include accounts of credit customers, which are debtors, and credit suppliers, which are creditors. Then let us now look at impersonal accounts. So impersonal accounts, these are types of accounts that are not personal accounts. Impersonal accounts are made up of real accounts and nominal accounts. So what are real accounts? So real accounts, these are types of accounts in which positions are recorded. These positions are made up of assets of the business, Examples of real accounts are inventory, furniture, buildings, machinery, stock account, cash account, and motor vehicle account. Then for nominal accounts, these are accounts in which expenses, income, and capital are recorded. Remember that real accounts represents assets which are in use over many accounting periods, while nominal accounts represents values which ceases at the close of each accounting period. New expenses and incomes of the same kind will arise again in the next accounting period and then again become extinguished with the close of the respective accounting period. Expenses are cost of running the business during the accounting period. Examples of expenses include purchases, salaries, insurance, electricity, and wages. Income or revenue is money that is earned in the business. Examples of incomes include sales, rent received, interest received, discount received, and so much more. So let us now look at the different types of accounts. So from that diagram we have accounts. So we have two types of accounts, so personal accounts and personal accounts. So we have said that personal accounts can further be divided into real accounts and nominal accounts. Let us now look at types of ledgers. There are two types of ledgers, namely the general ledger and the subsidiary ledgers. The subsidiary ledgers are divided into the sales ledger, purchases ledger, private ledger, and the cash book. So we're going to start with the general ledger. So the general ledger is the main ledger of the business organization, which contains all ledger accounts of the organization. The general ledger comprises of all individual accounts needed to record the assets, liabilities, capital, revenue, expense, and loss transaction of the business. In most cases, detailed transactions are recorded direct in these general ledger accounts. To prevent the general ledger from being overcrowded with transaction of the business, the general ledger is restricted to recording control accounts. The subsidiary ledgers are created where individual accounts are recorded and then the totals of the subsidiary ledgers are transferred to the control accounts in the general ledger. In this case, the general ledger is also known as the book of final entry. Then let us look at the subsidiary ledgers. The subsidiary ledgers are made up of the sales ledger, the purchases ledger, private ledger, and the cash book. So we're going to start with the sales ledger. The sales ledger is also known as debtors ledger or sold ledger. The sales ledger is the subsidiary ledger in which debtors accounts are recorded. A debtor is a credit customer. The sales ledger therefore contains personal accounts of credit customers. Each debtor's account is credited with cash received, discount allowed, and returns inward, since this transaction reduces the amount demanded by the business from the credit customers or debtors. Debtors accounts being assets accounts, they are credited whenever their values reduces. The balances of the credit customer's account shows the amount that the customer owes the business. Therefore, the total of the balances in the ledger is the total amount the business demands from its credit customers. This amount is called trade receivable or accounts receivables. The total of the account balances of debtors accounts in the sales ledger is then recorded in the debtors control account in the general ledger. Let us now look at the purchases ledger. The purchases ledger is also known as the creditors ledger or the bought ledger. The purchases ledger is a subsidiary ledger in which creditors customers are recorded. A credit supplier is referred to as a creditor. The purchases ledger therefore contains personal accounts of credit suppliers. Each creditor's account is credited with purchases, since selling to the business increases amounts demanded by the suppliers or the creditors. Creditors accounts being liabilities accounts are credited whenever they increase. The creditors account are debited when cash paid, discount received, and returns outwards, since the transaction reduced the value of these accounts and being liabilities accounts. They should be debited whenever they reduce. The balance of the creditor supplier's account shows the amount the business owes or must pay the supplier. Therefore, the total of balances in the creditor's ledger is the total amount the business is supposed to pay to or its creditors or credit suppliers. This amount is called the trade payable or accounts payable. The total of the accounts balances of creditors' accounts in the purchases ledger is then recorded in creditors control account in the general ledger. Let us now look at the private ledger. This is a subsidiary ledger where secret accounts or confidential accounts of the business are kept. Accounts to be kept secretly vary from one business to another. In general, secret accounts of the business may include accounts such as capital, loans, mortgage, director salaries, and so on. Let us now look at cash book as a subsidiary book. The cash book is also considered a ledger since it contains the cash account and the bank account. This is why it is also considered as one of the subsidiary books. Then let us now look at preparation of the sales ledger. When preparing the sales ledger, we simply prepare ledger accounts for each person to whom the business had to sell the goods on credit. The names of the people that buy goods on credit are obtained from the journal. The individuals that buy goods on credit are called the debtors. We transfer the total amount of credit sales in the sales journal to the debtors control account in the general ledger. Let us now look at preparation of the purchases ledger. When preparing the purchases ledger, we simply prepare ledger accounts for each person to whom the business had bought goods from on credit. Individuals that buy goods on credit are called creditors and are obtained from the purchases journal. We transfer the total amount of the credit purchases in the purchases journal to the purchases control account in the general ledger. So this is all that we're going to look at today. Where you have questions, please ask in the group. Those who have not yet joined our online tuitions are up and running, and the price is only 100 kwacha per subject. We provide the following subjects: mathematics, science, biology, and accounts. For further information, you can text me on WhatsApp on 0973023620. I'll meet you next time. Peace and God bless. So this program has been brought to you by Siwale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless.